In 2025, something happened that almost nobody saw coming. An asset that has dominated the financial conversation for over a decade, the undisputed king of performance, was knocked off its throne. For the first time in more than 10 years, Bitcoin was the worst performing major asset. While old school gold soared and delivered incredible returns, Bitcoin actually lost money. The data is stunning, and it points to a massive shift that every investor needs to understand. Forget the hype, forget the speculation, and forget what you thought you knew about the battle between digital gold and physical gold. We're not dealing with opinions today. We're sticking to the hard numbers. Today, we're going to get into the charts and the data that explain this historic role reversal. Here's the plan. First, we'll look at the shocking performance numbers from 2025, side by side. Then we'll unpack the three big reasons why gold had such an incredible year. After that, we'll flip the coin and look at the three major headwinds that caused Bitcoin to stall out and fall. And most importantly, we'll put it all together to figure out what it all means for your portfolio and the future of your money. All right, let's get right to it. These are the numbers that sent a jolt through the financial world. According to a key review of major global asset classes, gold finished 2025 at the very top of the leaderboard. It delivered a stunning 55.2% annual return, making it the year's strongest major asset. Now, look all the way down at the bottom of that same list. You'll find Bitcoin, which posted a negative 1.2% return for the year. Let that sink in. In a year where some assets were flying, the perennial champion went backward. To really understand how big of a deal this is, you have to see it in historical context. This was the first time since this kind of performance tracking began back in 2011 that Bitcoin has ever finished a calendar year in last place. For more than a decade, it was almost a given that Bitcoin would be at or near the top of the list. 2025 completely shattered that assumption. Now, to be fair, we have to zoom out and keep some perspective. If you look at the bigger picture, from 2011 to 2025, Bitcoin's long-term performance is still in a league of its own. Its cumulative return was an incredible 315,000%. Gold's return over that same period was a respectable 171%. The long-term story still overwhelmingly favors Bitcoin. But the market doesn't care about the past. It's always looking ahead. The story of 2025 wasn't about history. It was a violent and abrupt departure from a decade-long trend. It leaves us with the most important question for any investor today. Why did this happen? And is this a temporary anomaly or the start of a new paradigm? To answer that, we first have to understand the forces that push gold to such incredible heights. Gold's spectacular rise in 2025 didn't happen by accident. It was a textbook reaction to a combination of powerful, traditional forces. There are three main factors to break down. First, and most importantly, gold returned to its ancient role as the premier, safe haven asset. In times of deep geopolitical and economic uncertainty, capital doesn't look for innovation. It looks for safety. And 2025 was a year filled with uncertainty. As global tensions simmered and economic anxieties grew, investors made a classic flight to safety, moving money away from riskier assets and into an asset that has preserved wealth for centuries. Gold was the primary beneficiary of this global shift. And it wasn't just individual investors making this move. It was the quote-unquote smart money at the highest level. For the third consecutive year, central banks around the world continued their significant buying trend, absorbing massive quantities of physical gold for their reserves. While final year-end data for 2025 is still being tallied, the trend is undeniable. Nations like Poland have been notable buyers, part of a wider trend among emerging market central banks to diversify away from fiat currencies. Central banks don't buy gold for speculative gains, they buy it for long-term stability. When the institutions that control the world's money are stocking up on a physical asset, it sends a powerful signal about their outlook on the financial system. The second major factor was the persistent shadow of inflation. While headline inflation rates may have cooled from the fiery peaks of previous years, underlying price pressures remained stubbornly high, continuing to eat away at the real value of cash. Savers and investors globally were looking for a proven store of value, an asset that has maintained its purchasing power not just for years or decades, but for millennia. In this environment, gold was the obvious and most trusted choice, acting as a powerful and effective inflation hedge all year long. Finally, the third driver was a technical breakout of generational significance. For years, gold's price had been consolidating on the charts, building up energy within a massive pattern that traders and technical analysts were watching closely. In 2025, that move finally came. After decisively breaking through key long-term resistance levels, gold began a powerful, sustained upward march. The rally saw gold pushing toward the $4,000 mark, establishing new all-time highs in the upper 3,000s by the latter half of the year. This wasn't just a fleeting price spike, it was a technical confirmation that a new secular bull market for gold was firmly underway. While gold was enjoying a perfect storm of bullish tailwinds, Bitcoin was facing its own powerful headwinds. Its story in 2025 is one of massive volatility, regulatory friction, and a tough identity crisis. The first factor can be interpreted as the great ETF hangover. The market seemed to follow the classic principle of buy the rumor, sell the news. 2024 was the year of euphoric hype around the launch of spot Bitcoin ETFs. 2025 was the morning after. The initial flood of institutional capital was significant, but after that massive run-up in anticipation, the sustained real-world flows, while solid, simply couldn't keep the parabolic momentum going. The year was a roller coaster of extreme volatility. Having already entered 2025 in six-figure territory, Bitcoin went on an incredible run, printing a stunning new record high by briefly trading above $120,000 in the fall. But this peak proved to be a classic blow-off top. The market had gotten far ahead of itself, driven by leverage and speculative fervor. What followed was a sharp, painful correction into the end of the year. This retracement was so severe that it wiped out all of the year's impressive gains, dragging Bitcoin all the way back down to finish the year with that slight negative return of 1.2%. It's a brutal lesson in market psychology. The second headwind was the complex and evolving global regulatory landscape. While the ETF approvals in the US were a landmark victory, the regulatory battle was far from over. In the United States, the persistent lack of a clear, comprehensive federal framework for digital assets continued to cast a long shadow of uncertainty over the industry. This ambiguity makes it difficult for large, conservative pools of capital to enter the market with confidence. Meanwhile, across the Atlantic, the implementation of the Markets in Crypto Assets MiCA regulation began to take full effect in Europe. This sweeping legislation, while designed to provide clarity and protect consumers, also forced the industry to adapt. It created significant operational hurdles and market friction, particularly for some stablecoins. While these regulations are a necessary step toward the market's long-term maturation, in the short term, they contributed to the risk-off sentiment. Finally, the third and perhaps most telling factor was what the market revealed about Bitcoin's true character. In 2025, Bitcoin was forced to answer the question, is it digital gold or is it a high beta risk asset? The market gave a fairly clear answer. When the macroeconomic environment turned risk off, Bitcoin behaved not like a safe haven, but like a high-growth tech stock. As investors sought to de-risk, the first assets they sold were often the most volatile, and Bitcoin was sold off right alongside other risk-on assets. While gold was catching a strong safe haven bid, the narratives for the two assets sharply diverged. For that critical period in 2025, the market voted with its capital, and it decided that in a moment of crisis, Bitcoin was a source of risk, not a refuge from it. So what's the big signal here? What does this shocking role reversal in 2025 mean for investors? This wasn't just a statistical anomaly. It was a profound lesson from the market. Gold's incredible surge was a classic, fundamental response to macroeconomic fear. Its performance was driven by its ancient, time-tested role as a store of value, a hedge against uncertainty, and a safe haven in a turbulent world. Bitcoin stagnation tells a more complex story. Despite hitting a spectacular new all-time high, its failure to hold those gains showed a market that's still maturing. It's an asset deeply tied to the ebb and flow of risk appetite, and it is still grappling with the growing pains of regulation. The digital gold narrative, which suggests Bitcoin should act like gold in a crisis, was seriously tested in 2025, and it came up short. While its long-term properties, like a fixed supply, are indeed gold-like, its short-term price action is not. In a real-world stress test, the market showed a clear preference for the tangible, thousand-year-old asset over the digital contender. This does not mean the digital gold narrative is dead, but it has been significantly weakened. So what is the smart money doing now? The most sophisticated investors aren't framing this as a binary choice of one over the other. They are evolving to understand the distinct role of both assets within a diversified portfolio. Many are now using gold as the stable foundation, the bedrock that provides protection against crisis, while allocating a smaller, calculated portion of their portfolio to Bitcoin, acknowledging its extreme volatility but seeking its unparalleled potential for growth. One is for defense, the other is for offense. We also have to consider the sheer scale of these markets. Even after its spectacular 2025 performance, estimates of gold's total market capitalization continue to dwarf Bitcoin's. The total value of all the gold in the world is estimated to be more than 7 times larger than Bitcoin's market cap, which briefly peaked around an estimated $2.2 trillion. For Bitcoin bulls, this massive gap means Bitcoin still has substantial room to grow. This potential is why analysts at firms like JP Morgan have suggested a long-term scenario where Bitcoin could eventually reach a price of around $165,000 to $170,000, should it begin to match gold on a volatility-adjusted basis in private investor portfolios. But as 2025 brutally demonstrated, the path to that potential future is anything but a straight line. So to wrap it all up, gold's dominance in 2025 wasn't an accident. It was a classic flight to safety, powered by geopolitical fear, persistent inflation, and massive central bank demand. Bitcoin's underperformance was the story of a maturing asset facing new challenges, grappling with the aftermath of ETF euphoria, navigating a complex web of global regulations, and ultimately behaving like a risk-on asset in a risk-off world. Bitcoin lost the battle in 2025 because when push came to shove, the global financial system still trusted the old guard over the new contender in a moment of crisis. But it's critical to remember that this is just one year in a financial story that will play out over decades. The big question every investor should be asking now is this: was 2025 a temporary reversal, a one-time event driven by a perfect storm? Or was it the beginning of a new, long-term trend where gold permanently retakes its crown from its digital rival? And how does the upcoming Bitcoin halving cycle factor into this complex dynamic? In my next video, we are going to look into the on-chain data, the leading economic indicators, and the institutional flow data that points to where the smart money is positioning itself for 2026 and beyond. We will analyze whether the trends from 2025 are accelerating, reversing, or stabilizing. Make sure you are subscribed with notifications turned on so you do not miss that essential analysis.